What we just witnessed in the precious metals market is not a normal sell-off, and anyone telling you this was just a routine correction is missing the real story. Here on Global Pulse, we focus on separating noise from reality, and what unfolded over the last 48 hours deserves a closer look. In less than 2 days, an extraordinary amount of value vanished from metals markets, and the speed alone should make you pause. Silver was slammed lower by roughly 30% in a matter of hours. Gold took a double-digit hit. Platinum and palladium were crushed right alongside them. When you add it all up, trillions of dollars in market value evaporated almost instantly. And that's before even factoring in what was happening at the same time in equities. To put this into perspective for the Global Pulse audience, the losses in precious metals alone rival the economic output of entire nations. When you combine metals and stocks together, the destruction of market value over that 48-hour window exceeds what most countries produce in an entire year. This wasn't some slow bleed. This was a straight-down move that shocked even seasoned market watchers. Silver, in particular, deserves special attention. It just experienced its most severe single-day collapse in more than a century. That's not exaggeration. We're talking about a drawdown that hasn't been seen since the early 1920s. Intraday, prices were down as much as 35% before stabilizing. Moves like that are extremely rare in a modern market that's supposed to be deep and liquid. Now here's where things get interesting, and this is where I want Global Pulse viewers to really pay attention. If you only look at the price chart, it looks like absolute carnage. But when you step away from the screen and look at what's happening underneath the surface, the story changes dramatically. Before this crash even began, demand for physical silver delivery was already surging. On the first day that February contracts were eligible for delivery, millions of ounces were claimed. Not promised, not speculated on. Claimed for delivery. That matters. This wasn't a reaction to falling prices. This demand showed up first. The price collapse came afterward. Large financial institutions were issuing and stopping delivery notices at a frantic pace. Metal was being shuffled, reassigned, and repositioned rapidly. That behavior doesn't line up with a market that's supposedly weak or collapsing due to lack of interest. If demand were drying up, you wouldn't see that level of activity tied to physical settlement. And yet, while all of this was happening in the background, the paper price of silver was being obliterated. Even more telling is what happened overseas. Spot prices for physical silver in Asia remained dramatically higher than futures prices in New York. We're not talking about a small difference. We're talking about a premium north of 40%. After a 30% crash, that premium didn't disappear. It didn't compress. It held firm. In normal market conditions, when prices collapse, physical premiums shrink or even go negative. Sellers rush to unload metal, buyers step back, and the whole system cools off. That didn't happen here. Physical buyers stayed active. They kept paying up. The disconnect between paper and physical markets actually widened. That divergence is the key to understanding what's really going on. And this is exactly the kind of signal we watch closely on Global Pulse. Now, I want to address two very different groups watching this unfold, because how you experience this event depends entirely on your time horizon. If you're someone who focuses on long-term physical holdings, this kind of move doesn't carry the same emotional punch. Volatility doesn't shake you the way it shakes traders. You're not watching 5-minute candles. You're looking at supply trends, industrial demand, monetary policy, and long-range fundamentals. For you, lower paper prices combined with stubbornly high physical premiums signal opportunity, not failure. The structure you care about hasn't broken. But if you're a short-term trader, especially one using leverage, this environment is brutal. A 30% drop in less than 2 days is a liquidation machine. Stops get hit. Margin calls come fast. Positions are closed automatically, often at the worst possible moment. In markets like this, it doesn't matter how strong your long-term thesis is if you're overexposed in the short term. The market doesn't wait for explanations. Both perspectives are valid, but they are not interchangeable. Problems arise when people mix a long-term narrative with short-term risk structures. That's how accounts get blown up, and it's something I've warned about repeatedly here on Global Pulse. So, let's connect the dots. On one hand, we have silver posting its worst day in more than 100 years, with enormous amounts of market value erased. On the other hand, we have physical delivery demand accelerating before the crash, inventories under pressure, and international premiums refusing to break. Those two things don't normally coexist. If this were a genuine breakdown in fundamentals, physical demand would have collapsed first. It didn't. Instead, the pressure showed up where it always shows up first in moments like this. In the paper market. No new silver was mined during that collapse. No sudden surge in supply hit the market overnight. Industrial demand didn't vanish in 12 hours. Solar production didn't stop. Electronics manufacturing didn't grind to a halt. None of the core drivers of silver demand changed. What changed was positioning. Massive volumes of futures contracts were dumped into a thin market in a very short period of time. That kind of selling overwhelms liquidity and forces prices lower, regardless of underlying fundamentals. It triggers stop losses, margin calls, and forced liquidations. Once that cascade starts, it feeds on itself. This is how paper markets reset when they get too stretched. And there's another factor that can't be ignored right now, especially for Global Pulse viewers, watching the broader macro picture. Rising political and economic uncertainty in the United States. Markets are increasingly nervous about the possibility of a federal government shutdown. The odds of that happening in the immediate future have jumped sharply, and history shows that shutdowns create real economic damage. When the government shuts down, paychecks are delayed, contracts stall, approvals freeze, and economic data goes dark. That uncertainty hits confidence first, and growth second. Markets don't price that risk efficiently until it's unavoidable. The initial response to shutdown risk is almost always the same. Investors sell what they can to raise liquidity. Bonds move first, stocks follow. Riskier assets swing violently. Even traditional safe havens like gold and silver can be sold in the early phase as traders scramble to meet obligations. That appears to be the phase we're in now. But history also shows what comes next. Prolonged uncertainty and economic disruption eventually force policy responses. Liquidity returns. Confidence seeks shelter. Safe haven assets regain their footing, often aggressively. What makes this moment unusual, and why it matters for Global Pulse, is that silver managed to suffer one of the worst intraday collapses on record and still finish the month higher overall. Prices are up nearly 20% over the past month and have risen for 9 consecutive months. That's not what a dead bull market looks like. This doesn't mean the pain is over. Technical damage like this doesn't heal overnight. Volatility can persist. Further downside is possible, especially if liquidity continues to tighten or if political uncertainty escalates. Anyone trading on margin needs to respect that reality. But it does mean that the narrative of collapsing fundamentals doesn't hold up under scrutiny. The physical market is sending a different signal than the paper market. Delivery demand surged before the crash. Premiums remained elevated after it. Buyers didn't vanish, they stayed active. That tells us the system was under stress before prices fell, not because they fell. When paper prices are smashed while physical demand holds firm, it's usually a sign of imbalance, not weakness. It suggests that pricing mechanisms are struggling to reconcile real-world supply and demand with leveraged financial positioning. So where does that leave us here on Global Pulse? We're staring at a market that just experienced historic volatility, wiped out trillions in nominal value, and terrified short-term participants. At the same time, we're seeing evidence that physical demand remains strong and that long-term drivers haven't changed. The unresolved tension is this. Does the paper market continue to push prices lower through forced selling and liquidity stress? Or does physical reality eventually reassert itself and snap prices back violently? Add in the uncertainty surrounding government funding, economic growth, and policy response, and you have a setup that is anything but simple. This is not a moment for hype or panic. It's a moment for clarity. Know whether you're investing or trading. Understand your risk. Respect volatility. And don't confuse price action alone with truth. Markets can be irrational longer than people expect, especially when leverage is involved. But they can't ignore physical reality forever. What we're seeing right now isn't just fear, it's stress in the system. And stress always reveals where the cracks are. I'm Mitchell, and this is Global Pulse.